Hello and welcome, What the Finances, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what has happened in the world of finance, investing, and markets. On today's podcast, I'm happy to welcome Marko Papic, who's partner and chief strategist at Clocktower Group, as well as author of the book Geopolitical Alpha, an investment framework for predicting the future, which I really enjoyed. So, Marko, thanks for joining the podcast today.
Awesome. Thank you so much for having me, Anthony.
No problem. So, my first question, I'm assuming that you've talked to lots of people about geopolitics and what's happened in the world. So, what are the biggest misconceptions that you see people have?
In terms of the markets.
Yeah, or just geopolitics in general. I guess maybe also the impact that geopolitics have on markets.
I think the biggest misconception, there's probably three of them. First of all, that geopolitics is somehow different from investing. And what I mean by that is like that, gaining insights into what's going on the geopolitical front is different from your day-to-day job. We as investors, we spend a lot of time thinking about frameworks, fundamentals. We try to build net assessments off of which to trade, off of which to invest. And then when it comes to geopolitics, we're like, bring me some 80-year-old dude who used to work as Undersecretary of State for Eurasian Affairs, and he will tell me everything I need to know, and that's awesome. It's crazy. It's really, really interesting how we lose our damn mind when it comes to geopolitical research. And the truth is that it's the same thing. You need to have a framework, you need to do the research, you need to do the hard work, and then you have a net assessment. Now, is it going to be 100% correct? Of course not. So that's the second misconception, which is that geopolitics cannot be predicted. That's true. You cannot predict anything with high level of certainty. You also can't predict earnings of companies with high level of certainty, or the directionality of asset price moves using chart analysis and technicals. I mean, you can have a good handle on it, you can improve your knowledge. And that's what an analytical framework, that I've been talking about on geopolitics can help you do. It helps you direct into a, less wrong forecast. And then the third misconception is probably that, geopolitical events are something that you need to focus on a more shorter term basis. I mean, it's funny because I wrote a whole book about that, so shameless plug. The book Geopolitical Alpha is about generating alpha off of geopolitical events. But the truth is, like, that's not really what geopolitical analysis is about. Geopolitical analysis is more about geopolitical beta. It's about understanding the long-term trends that are going to move markets and are going to impact macroeconomics. But they're much more longer term. So, for example, I would say that far more important than the Ukrainian war or what's going on in China with zero COVID, which are all kind of political events, far more important is this trend where the median voters in the West have moved to the left, on the left-right economic spectrum, not on social issues. I'm talking about economics. That's really relevant because it explains why we overstimulated during COVID and why it's going to be very difficult to implement austerity over the next several months, and I think that that's an interesting trend. It's something that has investment relevance, but isn't necessarily a sexy news item that you get on the front page.
Yeah, and that was a really interesting point that you mentioned throughout the book, that median voter and the importance that they have in terms of who's elected and I guess the direction of economy. So why is it so important to understand the median voter, and I guess what influence do they have?
Policymakers and politicians, they react to material constraints. And so this is the whole framework that I've, really been emphasizing. And it's not just my framework. It's a framework used by intelligence agencies, by political risk consultancies. I modified it a little bit for investors. And so policymakers react to constraints. So what are some of the constraints? Well, if you're running a country like, Peru, long-dated bond yields are probably a constraint. You don't want to anchor the bond market if you are not printing a reserve currency, as an example. But the ultimate constraint in democracies, and I would argue in softer authoritarian regimes as well, is the median voter. And the median voter is obviously a philosophical concept. They don't exist. But it's this idea that there are important issues of the day. We're not talking like something that's a side issue, but important issues of the day, the median voter has a view. And you don't want to be offside of that median voter on their view. And so politicians are going to approximate the policy preferences of the median voter because it's a constraint to a policymaker. if you're offside the median voter, an opposition party will elbow you out on the curve of distribution of preferences, and they'll get closer to the median voter and win the election. A good example of this, is Donald Trump. Donald Trump beat Hillary Clinton handily, with voters making $60,000 to $100,000 a year in 2016. In 2020, right before the election, he took bad advice from Senator Mitch McConnell and did not stimulate with the third check right ahead of the election. And that $60,000 to $100,000 voter, a very important, pivotal American middle-class voter, overwhelmingly swung from Donald Trump in 2016 to Joe Biden in 2020. So Democrats recaptured kind of the lower middle-class voter. And that's a good example where, Donald Trump misjudged just how committed the median voter was during the pandemic to basically redistribution, a very non-American type of a stimulus. And I think that cost him the election. But that's an example of where being offside of median voter can be immediately a problem.
And do you think central banks have that sort of constraint as well in terms of the median voter, or do you feel like they've got that? Yeah.
Great question, Anthony, because that's going to be a huge issue. I mean, that's an incredible question, because that question is going to be the question of 2023, my friend. You nailed it. And here's why. Everyone's backing off right now. Everyone's cool. CPI has peaked. CPI is going to come. The way I say it is this. Look, the Fed could take a vacation. Okay, close up shop. We're at 4 or 5% CPI in 6 months. We all know this. CPI has peaked, blah, blah, blah. I can show you 60 charts. All right, cool. But what happens when we get to 4%? What happens in Q3, Q4 of 2023? When we get to 4% CPI and we stay there, and we stay there, and we stay there. That's when the central banks are going to have to say, okay, getting from 10 to 4 was actually kind of easy, and it didn't incur a lot of pain on the median voter. And the inflation versus recession cost benefit calculus actually favored cutting down inflation. There was fear of recession. Elizabeth Warren wrote a letter to Jay Powell like, hey man, watch out. But for the most part, Twitter, hashtag inflation was trending higher than hashtag recession. Now you get to 4%, okay? Now what happens? Well, first of all, a normal human being cannot discern the difference between 2 and 4% inflation. Let's just be real here. Second, at 10% CPI, your real wages are what? Minus 5%. At 4% CPI, your real wages are flat, if not positive. So who the hell is asking the central bank to go from 4 to 2%? Who is that human being? Some professor of economics at Yale? Some PhD in economics shaking their little fist at the perniciousness of a 4% CPI over the course of the rest of this decade? Nobody's going to have a problem with 4% CPI. Not the corporates who can pass on price increases, not the consumers who are making enough money to swallow it, and definitely not the politicians who are looking at the sovereign debt hoard and saying like, man, 4% for a couple of years looks like a good idea. And that's where the median voter does matter. I think the central bank would basically be committing the sin of monetarist jihad if they went from 4 to 2%. You know what I mean? This is like unnecessary hawkishness. And I think that you will see Q3, Q4 next year, the median voter have an impact on the central bank, where I don't think they're going to have the guts to go from 4 to 2%, because it's just like nobody's asking for that. And that's actually the biggest probably macro story of next year. Like, I don't want to put any trades on right now based on that view, but it's clear that if that happens, if the bond market has to realize that effectively, not de jure, but de facto, we have a new inflation target, bonds got to sell off again.
And I guess once people realize that, does that have an impact on, inflation and thoughts of, what could happen within a year? When the target goes to 4, does it then go up higher? I guess that's a challenge to look at.
Yeah, that's right. I think, if we're stuck at 4 for a long time, I think the central bank will be comfortable that they don't need to really, there's no urgency in bringing it down lower.
Yeah. So I guess if we take a step back and go back to your framework, there was a quote that I took from the book, which I think really explains it quite well. It was preferences are optional and subject to constraints, whereas constraints are neither optional nor subject to preferences, which I think explains it really well. So yeah, so let's say Italy, the new Italian president comes into power. She's, I guess you could say, pro-Russia, maybe anti-Euro. There's these preferences that she might have, and there's constraints as well. So can you maybe explain, like, I guess, the difference, and then how you can understand which are which?
Well, I think preferences are, stated goals of policymakers. Preferences would be ideological leanings. Preferences are everything that, well-connected consultants whisper to you in a meeting by name dropping. Here's what Vladimir Putin wants. Here's what Joe Biden administration is going to do. Preferences are basically the stated goals or the unstated goals. It's everything that resides in a policymaker's head. And the problem with preferences is not that they're not actionable. It's that you don't know what's in somebody's head. And the other issue is that preferences can change. They can change, and they're impacted by the material reality around you. So my preference is to drive around in a Bentley Coupe GT baby blue color, with like orange rims. Just don't judge me. That's what I want. But, and if somebody asks you like, hey, Anthony, can Marko buy a Bentley Coupe GT? You would be like, okay, well, you wouldn't ask like, well, does he want one? You'd be like, okay, well, can I see his bank account? Can I see his monthly earnings? Can I talk to his wife? Does he have kids? Where does he live? Those are all the things like that you would want to know. And similarly, I think what's interesting, this goes back to my first point when you were like, what are misconceptions about geopolitics? And my argument was, we think that somehow you can have these magical fairies come to your office and tell you what Joe Biden wants to do. Who cares? Who cares what Joe Biden or Putin or Zelensky wants to do? What we want to know is what are the material constraints around it. Now, again, if you could plug some special device into a policymaker's head, I'd say go ahead, spend the money on that device, get the preferences down. Let's know them. That would be awesome. I'm just saying we in finance, we don't have time for that. We don't have money for that. We need to start with something. And far more diagnostic than preferences are the material constraints. And that's, a good example of this would be Ukraine. I mean, I'm probably jumping a little bit here, but just I want to say, like, Ukraine is a great example. I keep getting these questions from clients. What does Zelensky want to do? When is he willing to negotiate? Is Putin willing to negotiate? And I say, like, who cares, guys? Who cares? Who cares what President Zelensky or President Putin want? I can tell you right now, their militaries both suck at offense. They're not doing that well. And so we're reaching a military equilibrium. And once the military equilibrium is reached, once you have stasis in a war, political equilibrium will follow. Or you won't. There was never a political equilibrium in the Korean War. The thing's been over for 70 years. And that's a great example of how you shouldn't be anchoring to policymaker preferences. You should be anchoring to the material world that constrains them and forces them down the political path of least resistance.
Yeah, that's super fascinating. So, you mentioned before, and we've talked about the median vote and how that's like a big constraint, especially with recent elections that we've seen where, let's be honest, a lot of it's happened in Australia, it happened in France, it happens in the US as well, where left-leaning parties did quite well. Are there any other constraints that you think maybe people aren't paying enough attention to at the moment, maybe just on a broader scale?
Well, I mean, I think China has multiple constraints. I think China has peaked as a global power. It's not a bearish view. It's certainly not a bullish view. It's just a statement that I think that China is in a period of digestion. It's digesting the growth of the last 2 decades and the negative externalities of that growth, whether that's income inequality, which the Communist Party has stated it wants to resolve, whether it's a massive amount of private sector leverage, which means that the domestic growth engine in China is going to take a vacation for the next 7 to 10 years. So China is in a period of digestion, and during this period, it's going to depend on external demand for its growth. And I don't see a country that's, addicted to external demand committing aggressive geopolitical acts. So that's one that I think most people, when they talk about constraints in China, they look at it militarily, like, can China effectively reunite, with Taiwan militarily? Like, can that happen? And then we do this order of battle analysis, which, by the way, is also a good thing to do, because I think that would also lead to a conclusion that China's constrained. But I think that we miss the economic side of this, the macroeconomic side, the fact that China is, really growth in China over the last 3 years has been export driven. And they're not going to be able to boost consumption. So the only way to offset that is to increase the investment side of the GDP, which will eventually lead to a current account deficit, which will then also make China not just addicted to exports, but also import of capital. Like, this is not a profile of a country that goes to war, for something that's optional. And this is important. Taiwan is optional. It's not critical. The other constraint, I think, is Iran. I would say that, but in this case, Iran is not constrained necessarily as much as it's desperate. Its policymakers have been put in a corner. It's a wounded animal. It's been waiting for negotiations for 10 years with the US. Europeans and everyone else in the world has told them, just be patient. Donald Trump will lose. He lost. Joe Biden comes in. Just be patient. Here's a deal. They themselves made a couple of mistakes. They were a little bit too aggressive in their negotiations. They could have concluded a deal 12 months ago. They missed that window, and then inflation came. Biden had to go to Saudi Arabia, and then you have this revolution in Iran, which is really problematic because it's a revolution led by gender equality. And it pretty much nailed the final nail in the coffin of negotiations, because you cannot be a liberal progressive president of the United States of America and then negotiate with a country that's, subjugating women. That's just not going to happen. And so I think policymakers in Iran are realizing that the negotiation path is over. And so they have to increase the cost of non-compliance to the West. And I think over the next 12 months, this will replace China and Ukraine on the front pages of our newspapers.
Yeah, it's fascinating. I think, one thing that's mentioned in the book about constraints, you talk about Putin, and obviously how you say it's quite unlikely that he would invade Ukraine because of constraints. But then we've seen that that's just because there's constraints there. It doesn't mean that people will go against them and try and do it. And now I think you could say, Iran as well as China have sort of seen the consequences, and they may be second guessing what they were, previous thoughts they had.
I think it's a little bit different. For China, I think for China, maybe. I don't think China was planning to be very aggressive. In fact, if you look at Chinese operations in the South China Sea, they've actually become less aggressive when it comes to, being aggressive towards their neighbors in the South China Sea, Vietnam, Philippines, Malaysia. When was the last time you heard about Chinese Navy harassing Philippines fishermen? That's more of a 2016 thing. Now, with the Senkaku Islands, with Japan, there was a couple incidents this year, which actually my Japanese clients reminded me of. But for the most part, it still hasn't reached the level of 2011, 2014, 15 level of tensions. So when it comes to it, Chinese assertiveness, they've already reacted to the constraints, I think. And so I think the probability of the Taiwan intervention was very low anyways. I think it's collapsed, perhaps, to your point, since Ukraine. On Iran, Iran has tools that it can use that Russia didn't. The biggest mistake Russians made, and there were so many mistakes Russians made, but the biggest one is they thought that somebody in Ukraine still liked them. And we have polling data that shows that Russian-speaking Ukrainians who were ambivalent about their nationality, they were. Everybody east of Dnieper, basically, decided after 2014 and 15 that Russia is not in any way their fatherland or motherland. And so when the Russians reinvaded in 2022, they found that 90 to 95% of the domestic population was extremely hostile to them. In Iran's case, that's not the case with neighboring Iraq. And I'm not saying that Iran would invade Iraq, but I can see why Iranian policymakers, now that they're cornered, now that they have no prospects for negotiations, they might use destabilization of Iraq through their Shia militant proxies in the country to, again, increase the cost to the West of non-negotiations. And to be very specific, what I mean by that is increase the price of oil. Throwing off all these market head forecasts of 4% CPI that are so certain that I was talking about earlier. And that's the only thing they have right now, I think, in their in their arsenal. They could also directly attack Saudi installations, as they have done in the past, but there's no plausible deniability in that. I think that would be less wise than causing chaos in Iraq. Again, I don't have high certainty of this, and I certainly cannot time it. But I would say that in Iran's case, they're so desperate that the whatever lessons they may have learned from Ukraine are not necessarily going to be applied.
Yeah, definitely. As you said, if they're in the corner, they might not have the option. So let's say you come up with these, constraints, you put your framework together. From there, how would you sort of, I guess, analyze when the time to invest would be, or what asset you choose to take that position as well, from your perspective?
Well, yeah, I mean, like macro assets are what I do. I don't do anything like I don't do names. I don't do equities. I do sectoral plays sometimes, but it really depends on the issue. I like currencies, commodities, sectors, relative sectors, European defense versus US defense, things like that. But what I would say is, first of all, when it comes to generating geopolitical alpha, it's much easier to generate it when the risk premium is in the market. So I tend to actually surprise people by being the geopolitical guy who doesn't think the world is ending. Like I would say 80 to 90% of my trade ideas are when I walk into an office of an investor and say like, yeah, you're trading something that's on the cover of The Economist. Good luck. And most of the time, what I mean by that is that when the risk premium is in the market, I either agree with it, and then I'm not going to talk about it because whatever, it's consensus, it's in the price, or I'm going to bet against it. I'm going to bet that there's an informational disadvantage that the median investor has because they don't understand geopolitics, and because they're reading newspapers for their understanding, they've probably been alarmed by something that will dissipate. So I like to harvest alpha as geopolitical risk premium is drained from the markets. And in my view, the half-life of the geopolitical risk premium is much shorter than people think. So the good example of this is this year's oil. This year, oil prices, I was very vociferous that oil prices should come down. I got killed on financial Twitter by every oil analyst because they tend to be bullish and they tend to look at inventories, which is like, my chocolate Labrador can look at inventories. They seem to forget that there's the other side of the coin, which is demand. And in this case, the fundamentals were telling you Chinese demand was weak, oil prices should be lower, but the risk premium was there out of the Ukraine conflict and the perceived importance of the EU oil embargo, which in my view was a PR exercise by the West. And so that's a good example of harvesting something like a risk premium that's come out. Now, the issue with Iran is interesting. So I'm telling you, like, look, over the next 12 months, I think there could be a serious conflict in the Middle East. And you're like, oh my gosh, should we go long oil? I tend to not like to do that because that's where timing is an issue. You see, when the risk premium is already in the markets, you don't have a timing issue. When the geopolitical risk premium has been applied to an oil price, something has already happened, i.e. the Ukraine war. And then you can apply your constraint framework and say like, okay, well, this thing is like blown out way too much. I'm going to harvest it as it comes down. The problem with like having a view of a risk that's coming and expecting risk premium to come in is that you can wait for a long time. So Iran could do something tomorrow, or it could do something 12 months from now, and you're sitting there for 12 months waiting for it to happen, losing money.
Yeah, I guess the challenge is there's so many other things that could impact that as well. So it might not just be the Middle East, there might be other factors.
Of course, exactly. And like you're betting on something coming that isn't there. I like to bet against the geopolitical risk premium most of the time. Now, it doesn't mean I'm always bullish. That's not what my analysis, it's not like I have an analytical bias towards bullishness. I just have a trading bias towards bullishness because it's much easier than just waiting, in the options market for something to blow up. By the way, I apologize if you can hear some buzzing in the back, but the building is under reconstruction. We have an office in a over 100-year-old building right on the beach in Santa Monica. And so it's like they have to reconstructed because concrete is falling off of it and threatening pedestrians. So just as a little explanation.
That's pretty immense. Yeah, I think we're okay. I don't think I can hear it. So that's a good thing. So I guess looking at that perspective, then you've probably thought that Russia has been given too much credit in terms of its military threat that it would have on I guess Europe as well, and maybe the spending from there. And then as well, I think you've talked about China and I guess the bearishness in China, and maybe you think that's gone a bit too far as well.
No, I think China's going to be the best performer in 2023, in my view. I've been on record since November. Stocks have ripped. My team in Shanghai has called zero COVID perfectly. I think we broke the story. It's at Shanghai Macro, if you want to follow on Twitter, at Shanghai Macro. So the office there knows what is happening. And not because we talk to people, by the way, to go back to the thing, you know, like, no, it's because we have a framework, and because we predicted 3 months ago, the Chinese policymakers were kind of running out of rope on the zero COVID policy for a number of reasons, not because of like protests or because people were angry, although yes, that too. So I think China is going to have a great year. And I think that it's an alpha generating opportunity. It doesn't mean that I think China in the long term is a great investment opportunity. I think there's still a massive amount of uncertainty. And so I just think that there's going to be a pop in 2023. And there already is like imminent pop. It's happening. So, you know, it can go on for a little bit longer. The other reason that China can do very well is because I think we're in the pocket where the 10-year is going to behave. So the 10-year has already rallied as we expected. We've been long duration since October. The 10-year yield has come down, which gives NASDAQ and ADRs in China, you know, a nice lift. So it's not just zero COVID. It's not the fact that Chinese premier is pro-business, pro-growth guy from Shanghai. All those things are important, but there's also a macro story that should lift TMT sector in China, which obviously dominates their sector, just like in the US. I think the more interesting one is probably what's going to happen with commodities. I think that's the big story. I've been very bearish commodities this year, which is interesting because a lot of my friends and clients were angry at me. They were like, but Marko, you believe in the secular commodity bull story. You've been writing research since 2020 about the commodity super cycle. And it's like, okay, but nothing goes in a straight line. There can be interregnums. And this year we had a significant interregnum in the energy and commodity markets. And that's because of what happened in China. And so that interregnum, I think, is over. And so I think that oil prices, but also metals, should do well in 2023. Now, the timing is really difficult. I mean, I'm surprised by the sell-off in oil. So I was bearish oil from 120 to 85. Now that it hit like 80, I'm like, wow, that's, I would have not made the money from 87, 85 to 80. And now I'm a little bit confused what's going on. I'm willing to sit on the sidelines, see where we go. Maybe there's more downside as folks price a recession, but I think that we're probably near the bottom. And so I would be looking to re-enter longs on commodities, given my structural bullishness. And this is something that's interesting. I think a lot of people struggle with navigating their secular stories and tactically trading them. And I don't mean just like people on Twitter, although yes, you, but also, I mean, like Goldman Sachs, I mean, Bridgewater, I mean, big names in finance will have very elegant secular stories and then not pivot out of those views on a tactical basis. So I think this is just a normal thing. I'm not saying I'm great at it either, but I think we need to be cognizant of our biases, of our long-term elegant narratives, and be nimble enough to move out of them.
Yeah, that's a super great point. So when you talk about China and I guess the potential upside they could have, it sort of makes me think about other countries close to them and who are influenced by them. So maybe Vietnam as well. They've had a really bad performance, I guess, over the past year, potentially influenced like that by that. So then could you get other, performance from there? But I guess the challenge is that you don't want to overcomplicate the trade, which is
no. I think you might want to overcomplicate the trade. Actually, you are correct. But I would look at it in DM terms. So I like Europe and Japan on that one. Now, Europe, obviously, I have to be correct on the Ukraine war. So my controversial view, the war is basically over. It's got to be right. So maybe we want to put that on the sideline, put a pin in it, because there's multiple steps required for European outperformance. Although I think long-term, that is the best trade. Japan, however, is an imminent, like it should be like ready. The decline in the yen tends to be good for Japanese equities. I know that's a little bit oversimplistic, and there's been some good research that suggests it's not the case anymore. But hey, look, that decline is huge. Should make Japanese exports more cheaper. That's a good thing. The problem for Japan is that their number one export partner, China, has effectively been in a self-imposed recession. So what you have is a coiled spring. Japanese currency is cheap. Exports have lagged because of this weird issue. Now China's putting a floor in growth in a dramatic fashion, in my view. That should allow that coiled spring to burst in Japan. So I think Japanese equities ought to be really good next year. I don't really have a great track record like trading Japan, except the currency. So I'm just gonna throw that one out there, and then people who are smarter than me can, tell me if it's right or wrong. But I think that Japan should be the best way to play China. Also, if you're sitting as a CIO of a big public, pension fund in Australia, Canada, US, in the West, and you have reputational constraints to trading China, and potentially soon legal ones, given what the Commerce Department is cooking in the US, it doesn't mean that you shouldn't follow China. This is I can see a mistake coming for a number of institutional investors around the world, where they're going to say, like, look, I can't invest in Chinese assets due to geopolitical issues, Commerce Department rules, so I'm just not going to pay attention to it. Oh my God, don't do that. China's not the Soviet Union. And what I mean by that is the Soviet Union didn't move the needle on any macro assets during the Cold War. China will move the needle. You cannot invest in Europe or commodities or Latin America or Japan without having sophistication about China. Whether you're trading Chinese assets or not, you better know what's going on in China, because it is the second largest economy in the world, and it's very much policy driven. In other words, you cannot just look at fancy charts and predict the future of Chinese economy. You have to have a geopolitical and political insight into it. And that's why I've spent so much time and effort building out the China team and having people there who understand the framework that I've developed, so that they're not just obsessed with rumors and contacts.
Yeah, and if you think about following capital, most of the capital, let's be honest, comes from the US in China. That's where most of it, yeah.
That's right. And the way I would say it is that, China and the US are like mom and dad. That's, if you're a macro trader, you have to understand them. China and the US, China's mom, US is dad. Okay. And mom and dad are going through a divorce right now. They haven't divorced yet, but dad is sleeping in a condo. And so in the beach house. And so that's really important, because you have to understand monetary policy in the US is particularly important for macro, because the Fed is the global central bank. On China's side, it's more of the fiscal. Chinese fiscal, because it tends, it's fiscal and credit, which is fiscal for them. Credit impulse in China is their way of fiscally stimulating. So you have to watch China for the fiscal. You have to watch the US for the monetary. And you have to text both your mom and your dad at Christmas. You cannot just favor one.
Got into family advice as well. I like it. Getting off the investing. But yeah, Marko, thank you so much for your time today. I really appreciate it. We've covered so many topics. I guess my last question is, what is one message you'd like people to take away from our conversation?
Well, I think, I always have the final message is kind of the same. It's not something that we talked about in the conversation, but it's something that I would say, I said it at the top, we all need to incorporate geopolitics now as investors. I got lucky because I failed in academia. I failed in political risk consulting. So I backed myself into finance, and I happen to have all this knowledge about politics, geopolitics. I got lucky. But what I would say is that we all now need to incorporate geopolitics as a tool in our toolbox as investors. We just have to. And the one thing I would say that's the most important is approach geopolitics and politics the way you do when you do technical analysis, or when you pick Microsoft versus Google. What am I saying? You don't cheer for Microsoft or Google. You're not biased towards Microsoft or Google. You approach these issues analytically. And so you have to do the same thing with geopolitics. And what that means is that, you need to kind of leave your biases at home. This is not the time to be an Australian or a Greek or a Serb or a Canadian, right? This is a time to be an analyst, and bathing yourself in indifference is the only way that you can actually trade geopolitics and politics. And most people, I would say 90% of investors don't. They have views that are based on their norms, ideology, morals, and that's fine. You can still be a human being, but be a human being when you're home at dinner with your family. Now when you're in front of your Bloomberg screen. When you're in front of the Bloomberg screen, be a robot that's analyzing geopolitics and politics.
Yeah, that's a great piece of advice, and I think you could link that to the energy companies as well. Maybe not geopolitical, but there's that's going back to the voter, the left-leaning voter. They're against maybe traditional oil, traditional energy, but they've overperformed ridiculously.
Well, that's actually great. Like I go to I speak to family offices who lean conservatively, and I've spoken to them in places like Texas and Alabama, and I would say to them, like, green technology is going to be one of the biggest investments over the next decade. And they get angry and like, climate change is not a real thing. I'm like, fine, that's cool. You may think climate change is a hoax perpetrated by liberal elites. That's your view. That's cool. But here's what's going to lead from trillions of dollars invested in this. There's going to be externalities that you can trade. Similarly, on oil prices, being long or short oil cannot be an ideological view. Like, if you hold it, my favorite trade for this decade is to have a barbell portfolio, where in the privates you invest in green tech, and in the publics you invest in brown stuff like fossil fuels. That should be a barbell that every family office applies for the next decade. And it's very ideologically weird, right? Like,
yeah, it's hedging basically all bets. So you get
that's right.
Yeah, the brown would give you, I guess, probably cash flow to start with, and then from there, if you wanted to, you can reinvest that into the private
into the green stuff. But like I think one interesting thing, I mean, Anthony, at the end, like, it's easy to be a good investor today, and I'll tell you why. Normative moral issues are starting to infect very large pools of capital. So you have these public pension funds that are not allowed to invest in all sorts of stuff that creates a sin premium in those sectors. But then now you have conservatives fighting against ESG, forbidding like Florida from investing in ESG stuff. Soon, public pools of capital. Oh, then there's China. China's now evil, so we can't invest in China anymore. But 5 years ago they were buddies. Whatever. What I'm trying to say is, like, there is so much morality and normative issues that are seeping into finance that those investors that don't have those mandates are going to be able to harvest sin premium off of stocks and off of investments. I mean, like, tobacco stocks are great stocks, right? Because nobody wants to hold them. The dividends are high. Similarly, there's going to be this sin premium now in everything, in China, in oil, in ESG, weirdly. As conservatives don't invest in ESG, as like liberals don't invest in oil. At the end of the day, like, the reason that we have fiduciary duties and responsibilities, and it's supposed to be the only thing you care about, is because it works. And I think that morality and normative issues in investing is very tricky. It is very, very tricky, and it's going to create a lot of dislocation and informational opportunities for those who are nimble and who approach investing in a nihilist manner.
Yeah, as you mentioned before, try and keep it quantitative, basically. Look at the numbers.
I would say, well, I'm terrible at math, so not
okay, not too much then.
You made me feel insecure. So what I would say is have a framework, and have a systematic approach. And that certainly can be quantitative. It can also be framework driven, where you abide by a set of rules and concepts that are about, getting the future right effectively, and not about anything else.
Yeah, perfect. I think that's a great message to take away. So, Marko, thanks again. So we've mentioned your book, which I'd really recommend people to read to, I guess, find out more about the framework. And then I think you analyze it against other, specific examples in the past, which is really useful. And where else could people sort of find your work?
So I'm on Twitter. So you can just Google or Twitter, Google, whatever. See, I'm old. Give me a break. Marko Papic is at geo_Papic. And as I said, Shanghai Macro as well is the office in Shanghai. So you can DM us if you're interested in research, and we can go from there.
Awesome. I'll put that in the description below. So, Marko, thanks again.
Thank you so much, Anthony.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.